Hey everybody, so lately I've been getting a bunch of emails all around the same concept or questions, and that is the market's been going down pretty much all year, right? Most people are down over 20%. Should I stop putting money away into my retirement account, or should I reduce what I'm putting away? Every time I put money away, it just keeps going down and down. Wouldn't it make more sense if I just kept my money on the side, wait for market conditions to improve, and then begin investing into my retirement account again? So I've got that question maybe 2 or 3 times over this past weekend. I got it a bunch last month. So we're going to go ahead and address that here today. So the short answer to that question is no, you probably shouldn't reduce what you're putting away for retirement just because the markets are down. Why? Because that really contradicts the age-old statement of buy low and sell high. The markets are going down, therefore when we're contributing into it, we are buying low. And then when the markets eventually rise back up, you're closer to retirement, you can sell off then, selling high. The key is always is remember that we are long-term investors. Just because we have one bad year in the market doesn't mean you need to jump ship and change your plan. It's just to stay consistent this whole time. Warren Buffett has this saying of be fearful when others are greedy and be greedy when others are fearful. And we look at what's happening right now, a lot of people are fearful. Looming recession concerns, all kinds of things going on around the world, elections coming up, you name it. Everything's pointing towards the negative, and the media really paints it in that picture. So when others are fearful, you should do the opposite and get greedy. So rather than decreasing or stopping your contribution, do the opposite. Why not put more money away into retirement? All the limits for retirement accounts in 2023 just got a big increase. So you should probably look to make full use of that while you still can and put more money away while the markets are still down. So one of the reasons why I think people have trouble with this concept is we don't really quite see what we're doing behind the scenes. Remember that when we're investing, what you're really doing is you're buying shares, right? So rather than focusing on how much money my account's worth and how much I lost, look at how many shares I am buying. Even though your account's down, the number of shares you're buying is increasing each and every time you contribute money. When the market is lower than it was before, your dollar goes further. We call it dollar cost averaging, right? So think of it like when you walk down the candy aisle and you see, the buy 3, get 1 free. This is kind of the same concept. Now it's really buy 5, get 1 free, just in terms of stock. So if you want something to do to make you feel better, go ahead and look at a recent statement and see how many shares you have, and then look at the previous quarter or even the previous years and see how much more shares you're buying now that the markets are down. And a lot of this is, again, hard because it's all digital. Most of us aren't really looking at statements. And if we do, we're definitely looking at how many shares or units, what some people call them, before the computers. When you bought a stock, you get a certificate, right? So you would have 1 share of it. So the key here is to keep buying, buying, and buying. Even though you don't see the physical property that you're buying, you are accumulating shares. And over time, especially when markets are down, your dollar goes further, you're going to end up with a whole lot more stock. And when this comes around in value and goes back up, you're going to see your account grow by a ton. Remember that because we're buying more and more shares, the market doesn't even have to go back to 100% before you see your account go back to what it used to be. Because you have more shares, each share doesn't have to be worth as much now in order to hit what your dollar value was at the start of the year. So keep focusing on buying more and more shares. One other way to look at this is think of this like going to the grocery store. We all go to the grocery store to buy things that we need. Occasionally when we go there, we see something on sale. Now, when we see something on sale, more than likely we're going to buy it or buy more of it because we want to get that good deal before the price goes back to normal. Stock market is the same thing. When we see the markets go down, the stock market is on sale, right? We are 20% cheaper than we were last year. So rather than being scared and not putting money into it, you should do the opposite, right? Do what you do when you go to the grocery store, load up on it. Why wouldn't you, right? So stopping your contributions when the markets go down is like going to the store to buy a gallon of milk, seeing that it's $1 off this week and saying, no, I'll come back next week. I don't like the sale price on this one. I'll come back when the price is a little bit better, right? So it sounds funny you put in that conditions, but that's exactly what you're doing when you stop putting money in the market when it's down. So remember, do the opposite, keep investing, and heck, buy more if you can. Now, if this is a real struggling point for you because you're getting close to retirement, please know that you're not alone. We're all going through the same thing together. I can show you my email list that has tons and tons of these questions coming in every single day. So know that you're not alone. And if you need help with this, it might be time to reach out and get yourself an advisor or get yourself a new advisor if you're not really communicating with your current one. Because really, when you look at it, we all are human. We all are going to have these bad ideas or these ideas that may or may not work. And the only thing standing between you And the bad idea is often your advisor or someone that help you guide make these decisions. Remember that one bad move, or actually one bad idea, can cost you years of good financial planning. So having an advisor is a lot more than just knowing what stocks to buy and sell. It's the emotional or behavioral component behind it all to keep you in line with your goals and keep you investing. And we do this with our clients constantly because just like you, they're human and these ideas come up. So likewise, I have the same kind of things. And I have other advisors that we talk with. We have our own mastermind meetings that we can go and put our brains together to kind of help us get better, right? So it's not you guys that only have advisors. We also have kind of talk to each other from a business standpoint as well as personally. We know that when we're doing our investments and moves, we have someone to bounce these bad ideas off of, so we don't just make crucial mistakes without anyone's input. So advisors do a lot more than investing. If you need help with this kind of stuff, go ahead and find one. Trust me, they're probably worth every penny, much more than what the media and other people may tell you that they're worth. So if this is something you are really struggling with, go ahead and consider hiring an advisor to kind of help you get through this sort of thing. Because financial services is an intangible thing, sometimes it can be hard to see the value. But even though what I just told you here today helps, and you stay investing or you put more money in it, it's probably going to wind up making you thousands, if not tens or hundreds of thousands of dollars more than if you went with your emotions and pulled the money out of the market or put less money in the market or something like that. Now, on a closing note, if you are putting money away into your Plan Pure DCP accounts, but you're still kind of unsure of you're investing the right way, you have the right risk tolerance lined up, should you be making any changes based on what's going on with the world right now, we have a service for that. We go ahead and build out portfolios for everybody, whether you're an aggressive investor, middle of the road, or conservative. We can tell you exactly what to buy and what to sell every single quarter so you can invest with confidence and you can completely take the guesswork out of it. Best part is the cost of service as of today costs less than what you pay on your garbage bill per month. So we want to make it really affordable to help as many people as we can. If you've never invested before, don't worry, it's a lot easier than you think it is. You might take us a little bit of time learning, what button to click at first. I have tutorials for all of that. Once you get the hang of it, you can probably get the thing done in maybe 10 minutes at a time. So if you can spare 30, 40 minutes a year to get more hands-on with your retirement, could be well worth it in the long run. So go ahead and check out that service. It's just called TERS 3 and DCP Advice. The link is in the description below. I'll see you guys next week. And remember that your future depends on what you do today.